And welcome back to the Opportunistic Trader. It is 9:45, just slightly after the opening. Looking at the S&P market, it opened a little bit firmer above 2840, and has sold off. The Dow is the underperformer today, down about 70 points. We'll keep an eye on all of that. As well, oil has come off the high. It made a new high just pre-opening and now has traded down about 60 cents. So it'll be interesting to see at these levels whether we can hold. I'm thinking that we will probably not hold in here, but it'll be interesting to see. But more importantly, I'd like to introduce to you Phil Flynn, who I've known for over 25 years and has been providing me market information that has helped me become very, very profitable. He works at the Price Futures Group, and he is a contributor to the Fox Business Network on a weekly basis minimally. And I'm going to throw it to Phil, and he will go over his market insight and views. Welcome, Phil.
Hey, good morning, buddy. How are you? It's great to be here. It's great to have everybody here on this great website and with such a great team. And it has been an interesting day on oil. We had a big pop this morning, and actually we did have a lot of bullish headlines. Starting with Friday, the U.S. rig count actually fell, according to Baker Hughes, by 2 oil rigs last week. And also there's more reports about shale oil production and why maybe we're not producing as much oil as we think we are. The Energy Information Administration last week lowered their previous estimates for weekly increases in oil production. And what we're hearing in the Permian Basin, that the production decline rate for the oil fields are a lot higher than the market believes. Why is the Energy Information Administration overestimating production every week? Well, we believe it's their methodology. They count holes in the ground, not necessarily where these holes are. And they're counting some drilled but uncompleted wells that they think should be producing, but they are not. But that's sort of started the support on Friday. If you remember, on Friday, market trading was very soft. And then, of course, this news came out late in the day. Everybody had gone home. Nobody cared. But it gave us reason to be supportive over the weekend. The other big story that has given the market support today is an estimate about Saudi Arabian oil production. Last week, oil prices got hammered on reports that Saudi Arabian oil production surged to a record in the month previously. But now, according to different sources, it appears that Saudi Arabian oil production has fallen back again by about 200,000 barrels a day. So this kind of offsets the scenario that Saudi Arabia was just going to continue to raise oil production, keep pushing their production above a record high. It also raises the question whether the Saudis can maintain that higher production output that we saw last week. There's some people that doubt that Saudi Arabia at this point has the ability to significantly raise production, okay? And so now we saw a big spurt in production. They weren't able to maintain it for more than a couple of weeks. So it raises questions about how much oil Saudi Arabia can actually pump on a sustained basis. And it also calls into the question spare production capacity for the entire globe. One of the things that we're seeing right now, because global oil demand is approaching 100 million barrels of oil a day, we're at a situation where the globe doesn't have enough capacity really to handle any increases in production or any surprise drop-offs in production. So what we're seeing here, and one of the reasons why the market continues to be pretty well supported, even as we're kind of getting towards shoulder season, is the lack of spare production capacity. Now, if you look at the market action that we've seen for the last Friday, we started the 4th of July with very strong oil prices. Into the 4th of July, when we started talking about tougher sanctions on Iran, prices went up. But really, almost on seasonal cue, you did see the oil prices sell off right after the 4th of July. Some pressure from the Trump administration for OPEC to raise production, and all of that created the sell-off that we saw during the recent weeks. But if you really look at market action the last couple of days, we're really in this kind of trading range situation that's being dictated by outside headlines on a day-to-day basis. We know that this time of year, that's not to be unexpected. Usually when you get into early August, with the maintenance season ahead of us, the best of the summer driving season behind us, you get into the seasonal no man's land right now, and that's where we're kind of in right now. We know, despite the fact that U.S. refiners are refining a near record amount of oil for this time of year, there is some concern that in the coming weeks we're going to see the demand slow down a bit from refiners as they get into seasonal maintenance, and that's keeping us in this tight range. But we believe that this is the calm before the storm going into the next quarter. We believe that as we get into the last quarter of the year, the last part of the year, that we're going to see the tightest oil market we've seen in over a decade, probably since 2005 or 2006, mainly because the global demand situation is up, and there's been an over reliance by a lot of people in the market on shale oil. Everybody thought that shale oil was going to be the panacea that could be the new, make the U.S. the new swing producer in the United States and the world, be the new Saudi Arabia, where they can just raise production or lower production at a whim and control the global market price. The reality is, if you understand the shale market, is that is impossible. First of all, shale oil companies operate independently. Number two, because of the transportation bottlenecks, pipeline bottlenecks, it keeps it a lot tighter, and it's a lot more difficult for the shale patch to act quickly to raise production. So what we did see in the buildup to the oil market over the last couple of years was the biggest cutback in capital spending that we've ever seen before. And so this leads us to believe that the market is structurally undersupplied right now. The traditional oil projects that should have been built to meet growing demand were never built, mainly for some reasons that aren't going to happen. For example, peak oil demand, things like that. So what we're saying that right now is that despite we've seen some recent weakness in prices, and oil prices might go down $1 from here or up $1 from here, we may stay in a tight trading range here for the next couple of weeks. At the end of the day, we think this is the calm before the bullish storm. We just had some breaking news from, well, it's not really breaking, but we knew this on Friday, but brand new news about the fund managers and their positions on gasoline futures. And this weekend, commodity funds put on a big bullish position in gasoline, and really starting to load up on the long side on the RBOB futures. And if we've seen recently, the RBOB futures have been relatively tight. But what we're seeing here is that as we get into the refinery maintenance, and with gasoline demand being at a record high, we think that the prices of gasoline on the RBOB futures have a tendency to rise counter-seasonally. So we're expecting that to happen as well. So that's going to be another thing that we're going to be looking at. The other long-term outlook is for the distillate numbers. Distillate, of course, we were seeing supplies well below the 5-year average, which means that we are going to be susceptible to price spikes this year and this winter. If we have a cold winter, we can see those prices really start to spike as we get into next winter. In the short term, we're seeing a lot of geopolitical risk. One of the things that may move the oil market today is the actual details of the Iranian sanctions that are going to be put in place by the Trump administration today. That is going to be something that the market's going to be worried about. It's potentially going to reduce supply, and there's not a lot of easy ways that we're going to be able to replace Iranian oil. Now, I know that Europe continues to say that they want to do business with Iran. We know that China stuck their nose at the United States and say, hey, we're not going to buy U.S. oil because we're mad at you about the trade war. We're going to buy Iranian oil. But the reality is that the major energy companies would rather do business with the United States than they want to do with Europe. So even these European companies are already making plans to live in a world without Iranian oil. So we're definitely going to see the loss of a tremendous amount of Iranian oil. Their production is going to fall, and that's going to tighten the markets up even more. Over the weekend, the Iranians, of course, said that they were holding a military event where they would be out sort of war games to prove that they could shut down the Strait of Hormuz if they so choose. Obviously, that's another tension that's riding the market. How many people saw Venezuelan President Maduro over the weekend in his speech with the exploding drones in the middle of the air? Now, there's a lot of people that believe that that was just for show and was just an excuse for Maduro to put some more political enemies in jail, as if he needed an excuse. But obviously, the ongoing situation in Venezuela is another situation that is going to keep the market moving. What's sad about the Venezuelan situation, the U.S. is still buying almost all of their crude because our refiners need their heavy crude. That's keeping them with some cash in the short term. But obviously something the market's also watching on. We also had a report in Iraq. The southern city of Basra had protests trying to block some of the main roads to the oil tankers, shutting down some of the fields in Basra. Just another sign that the tension in the world is still running very high and could have a problem for oil. As far as the rest of the situation that we have with a major Canadian resource company shutting down production of some of its heavier oil, mainly because they can't get it out of there to the U.S. refiners. And so the price differentials are so low that they're cutting back on that supply. So there's a lot of things that happened over the weekend that's giving the prices more support. If we weren't, for example, moving quickly in the shoulder season, I believe that we would have seen some more upside on these particular prices for the oil. Having said that, I think that there's a much better than average chance for oil prices this week to get back above $70 a barrel. And we're not that far away from it right now. Let me tell you some of the reasons why I think that. The first one's going to be the oil inventories. Last week, we saw a surprise increase in crude oil supplies. Most of that build was on the Gulf Coast. In fact, a dramatic amount of that was on the Gulf Coast. If you look at the other main points that you look at these inventory reports, like Cushing, Oklahoma, the Midwest, those supplies were much more supportive to prices. Recently in the Gulf Coast, one of the big swing factors has been U.S. oil exports. And for some reason, U.S. oil exports went to zero practically last week. We don't believe that U.S. oil exports are going to zero week over week. We think that that was an aberration, and we think that the U.S. oil exports are obviously going to pick up again this week. In fact, what generally has happened in the past, when we've seen a big drop in U.S. oil exports, they rebounded twice as much the next week. So we believe that it was a glitch, and that's probably going to lead to a pretty big drawdown in crude oil supplies this week. Refinery runs, we had some refinery glitches the week before. Some of those refineries are coming back online. That means that we should see an uptick in refining activity again, and that should suck down some of those extra barrels of crude. So we put this all together. We're predicting that this week for the Department of Energy or API, whoever gets it right this week, because as you know, when we look at API numbers, they're from Mars. And we look at the Energy Information Administration, they're from Venus, right? They never on the same page, even though they're reporting on the same things. So we're looking for a drawdown of 3.3 million barrels in crude oil this week, which should be, I'm not sure, I have not seen the other expectations coming in yet. We're also looking for a drop in gasoline supplies again this week. That could be as much as 3 million barrels. Last week, we did see an increase in gasoline supplies, but ready-to-use gasoline supplies actually fell. We think that right now the refiners are going to be looking ahead to the winter blends of gasoline, so they're going to try to draw down some inventories, but they have to balance that with the fact that U.S. gasoline demand is knocking on the doors of a record consumption week after week after week after week. That record gasoline consumption obviously is a reflection of the strong U.S. economy. We've seen not much reaction at the pump with the higher prices, and so we're looking for that to continue to be strong. Distillates is going to be another area that we're going to be focusing on. If you know any farmers and they're not hedged, get hedged. This is the part of the market that could be explosive over the next couple of years. It has one of the biggest risk factors, and it really is a situation where we've had undersupply. One of the issues we've had has been U.S. production of the heavier fuels. Shale oil does not produce a lot of the heavier type of distillate that the market has been looking for. And to be honest with you, Venezuelan oil that we're having a hard time getting our hands on really does a good job with that. But the global demand for distillates has been through the roof. So this is a market that has the potential for a big upside move at some point in the last quarter of the year. Now, earlier in the year, in the beginning of the year, we put out our long-term price recommendations. And early in the year, and this was quoted in Barron's as well, we said that that we believe that oil was going to go to $80 a barrel, before the end of the year, possibly as high as 84. Our target has not changed, even with the attempts of OPEC to raise production, even with the Chinese tariff wars and trade wars, and even about the fears of a slowing economy or weakness in Europe. We think the die pretty much has been cast as it comes to inventory. We don't believe that there's going to be enough oil to stop that run in the end of the year, unless we have a major, financial slowdown. And based on the economic data that we're seeing around the globe, even though there's signs of weakness in certain areas of the globe, from an oil demand standpoint, the trajectory that we're going to be on going into winter is going to keep this market extremely tight. So I guess what I'm saying is that if you do see market weakness going here, we believe this would be a good time to position for some bullish strategies going into the end of the year, because we could see a very quick $10 move to the upside at any point. More than likely, the bulk of the move is going to come probably next month. It'll probably get started because August and early September is traditionally, kind of a weak time. But as we get into the end of the year, we should have a very nice bullish move. Now, kind of interestingly enough, I don't know how many people have followed me for a long period of time, but I just want to give you a little bit of background of where I think we are in the overall oil cycle. And interestingly enough, one of my main claims to fame back in the last decade is when oil prices in 98 and 99 went to $10 a barrel, we basically said, that it was going to probably go to 40 or 50 in a couple of years, which it ended up doing. It ended up going to much higher. But we believe that oil is a very cyclical commodity. And we believe that 2014, 2015, when oil prices came close to double bottoming at $26 a barrel, speaking in rough numbers, is the same thing that happened in 1998 and 1999 when oil prices double bottomed at $10 a barrel. And really, if you look at the similarities of what's been happening in the oil market back in 98, 99, 2001, 2002, 2003, compared to what's been happening since 2014, 15, 16, 17, 18, they're eerily familiar. In fact, we believe that it is almost a perfect reenactment of what happened back then. And there's so many similarities. For example, back in 98 and 99, everybody told you that oil prices, or a lot of people were saying oil prices would never trade above $30 a barrel again. Why? Because the computers were going to be so much more efficient. So oil companies stopped investing because they believed in this false narrative. Let's fast forward to 15, 16. Oil companies stopped investing because everybody said shale oil was going to keep prices low forever. You heard predictions that, that oil prices were going to $10 a barrel, and that producers were going to have to learn to live with $10 a barrel, and that some people were predicting oil would never go above 40 or 50 again. It also was a time where OPEC and non-OPEC conspired and worked together to get prices up. That happened back then. It's happening again now. So if you really want to get a view, get a monthly chart out. Look at 98, 99, 2000, all the way up to the run up to 2008. Compare those charts to 2015 and 16, and you'll see that they're very similar. And we believe that the cycle is in. Back then, they called it the super cycle. I guess we can call it again. We're in a super cycle again on oil. Short term right now, I don't see a lot of downside in this market. Maybe a couple of dollars. But we think that the market's going to stay relatively well supported for the rest of this week. So that's really what we have. So use this opportunity to position for some long-term moves. We feel that the back end of the curve in oil, if you're patient, is a good well. And that's pretty much it. So I think we're kind of rocking here. And I'm going to leave it open here. And
I appreciate that, Phil. It was very insightful. I just had, for myself, a few questions. One is, what potentially? I know you went over a little bit, but I just want to cue on this a little bit. What potentially could make you bearish or change your bullish view, not only for the shorter run but for the longer run?
I think it would have to be a major financial meltdown at this point. Something that is, a recession in the U.S., a major global recession. I think that is going to be what's going to take it, because you can't underestimate the fact that U.S. energy companies have wiped out over 10 million barrels of future oil production by lack of investment. And to me, the market is just starting to become aware of what's been lost in the last couple of years when it comes to future production. And in a weird way, the cutbacks in production really it's almost like taking out one of the world's biggest oil producer and just subtracting them off the map. I mean, that's how much oil we're talking about. So for me, really to change my bullish outlook today, I'd have to see a major economic downturn, a black swan, if you will. I mean, a lot of people say the black swan could be the trade war, that we're going to push China into a recession, that they're going to stop consuming oil. We saw some soft data out of the European manufacturing sector today. But I actually think, at least for the short term, the impact of the trade war is not going to have a big impact on oil demand. We think that domestically, China's going to have to stimulate their economy. Every time they've done that, they've increased their oil demand. India, for example, they are already looking for alternatives to Iranian oil. They're a big importer of Iranian oil, but their demand we expect to continue. So I think we're behind the curve right now when it comes to oil investment. We have to play catch up, and we're going to catch up either one of two ways. Number one, production's going to go up. Prices are going to have to go up high enough to slow demand, or we're going to have to see a slowdown in the economy. Now, we did get some breaking news just as we've been on the phone. Genscape, the private forecasters that the market looks at, showed a drawdown in inventories again from last Tuesday of 125,000 barrels. Not a real bullish number, but it shows that the drawdown in Cushing, Oklahoma, which has been a focus of the market, is continuing. This came from a secondary source. From Friday, supplies in Cushing fell 1.255 million barrels, an additional 125,000 since the last report. Not a big drawdown since Tuesday, but a continuing draining of the Cushing, Oklahoma storage point.
I appreciate that. One other question. You talk about maybe the potential for a little bit lower in here, and obviously from your view, you're extremely bullish on the market, and I get that. But the product in the front month is trading at 69 and some change. In looking at that, what levels would you think would be a good area, for a longer term positioner or somebody that's looking to get long at at lower levels? What are we talking about? What levels are you thinking?
Well, I think if the short-term numbers, not necessarily long-term number, in the front end of the curve, you probably would be looking at about $68 today. The lower Bollinger Band comes in around 66.44. So if you were going to get an extreme sell-off, that would be the number that I would say, hey, we're oversold. That's the area that we shouldn't get much below. So if we happen to pull back $4 from where we are now, I would say that would be a very strong area. It would take a headline, I think, to get us down there. Some kind of real negative headline to get us down there. If you look at the bulk of the trading here the last couple of weeks, we've been in a very tight trading range where 67's been the low end, say 70-50 has been the high end. I really believe that that's the trading range that we're in because we're in shoulder season. So I would expect anything in the low 67s probably should be bought. If you get to 71.20 quickly, it probably should be sold from a short-term basis. If you're looking at heating oil, you might want to go out to look at the February 19, and if you're not hedged there, we're saying that a really good number to buy that would be 211 area if you could get down there. We think that you could make a dime on that from where we are now fairly quickly as we get a little closer to winter. So the February heating oil might be a good one to position. And as we mentioned, the hedge funds are starting to buy gasoline, which is, looking at the market activity, you would say, why are they buying gasoline? But I think there's a sense that the refiners are going to have to really max out distillate the best they can at the expense of gasoline. And so they perhaps are buying the weak sister right now.
Oh, I appreciate that. Just two more questions. One is, I just want to clarify on the upside, you're looking for a year-end target of above $80 on front month crude.
Correct. Right. And that would be on the rollover. So I'm not sure exactly what month we're going to get it, but more than likely. Last year, of course, we had 65 for a target, and it took forever to get there. We didn't get it till the last couple of days of January. So we might get into a situation like that. And if you remember last year's activity, oil prices, the midsummer, right around the summer solstice, we're trading around $42 a barrel. Everybody thought, oh my gosh, they're not going to get up there. And we kept our $65 target. And then sure enough, by the end of the year, we got that kind of a run. So you can go through these periods of weakness where it looks relatively weak before the market starts to get going. And I think there's two things right now that are hurting oil prices. Part of it is seasonal. The refineries are going to be going into maintenance here at the end of the month. Part of it's the strong dollar. But I think considering the strong dollar, I think prices are holding up pretty good. And as the refiners start to panic a little bit later in the year, trying to get their hands on the right kind of supply, that should give us a nice little squeeze into the end of the year.
Thank you. One last question. Are you looking at any other commodities in particular that you see something that sort of stands out to you?
Well, right now, for traders that do not have concern about taking delivery on August cattle, we think that the long August, short December cattle spread is kind of an interesting trade right now. The cash market for the cattle is much higher than where it is currently. And so we're spreading that against long December as we think there might be a little bit of a squeeze on the August as we go into expiration versus the December. So that's a really good one to watch. Natural gas, which has been bailed out by Mother Nature time and time again, is being supported by some warm weather right now. We do think there's a possibility that when we get into the fall, natural gas prices could collapse, which is kind of crazy to say that because supplies are so far below the 5-year average. But because of the record production in the U.S., we think that supplies are going to rebuild fairly quickly as soon as it cools down. So that might be a good sleeper to pick up some cheap puts going into winter on the natural gas, because we might get a nice little sell-off on that because of record production.
I appreciate that, Phil. You're very insightful, and as always, I look at your levels and I use you to trade off of. And again, it's been very insightful.
Thank you, Michael. I appreciate it, my man.